Welcome to Crops, Cattle, and Charley. I'm Charley Martinez, and I'm joined today by Andrew Griffith and the University of Tennessee crop economist, Dr. Aaron Smith. He's with the Department of Ag and Resource Economics. Dr. Smith is going to be discussing speculation in the crop markets. One of the first questions that kind of come to my head, Dr. Smith, is should producers speculate on agriculture commodity market rebounds?
This is one of those questions where there's really not a good answer to it. I do want to point out a few things before I kind of get into it. One is there's a very big difference between speculation and risk management tools such as hedging. So you want to make sure that you're not confusing the two. Speculation is just what it says. You're betting that you will increase or decrease in prices and profit from that decision. Management is something that's very different. So you do want to make sure that you understand the risks and the possible payoffs before you enter into any position in the commodity futures markets. We've seen substantial decreases in commodity prices recently due to the COVID-19 pandemic. It does end up adversely affecting a lot of our row crop operations. One of the things that is also important to understand is we can see these markets continue to go lower, and we're likely to see continued volatility. So if you do choose to speculate in the futures market, there's a couple of things that are really important to understand. The first one is do not risk money that you cannot afford to lose. This is something where there is a substantial amount of risk when you speculate in the markets. Point is make sure that you have substantial liquidity, or at least sufficient liquidity to cover movements or volatility in the markets, having a price movement against you, i.e. if prices continue to go down, you need to make sure that you're not exited from that position so that you have liquid reserves to cover margin calls and those types of things.
Well, Dr. Smith, how can a producer take advantage of rebounds in commodity prices?
Well, there's two primary tools that you consider, and one involves futures, the other one involves an options position. So again, what you can end up doing is if you speculate that you think futures are going to continue to or start to go up, you could end up purchasing a futures contract deferred, so you could look at different months and take advantage of price rebounds just as those contracts potentially go up. Again, there's no guarantee on that. The other potential alternative is you could use options. So you can have call options and take advantage of price increases that way. The real benefit to using call options is you have a more limited, defined, if you're purchasing a call option, potential loss, where you know what you've risked through that option premium. So those are the two main futures tools that are available to end up taking advantage of futures market increases. In terms of in cash markets, what we're looking at in those ones, the primary one is storage. And storage is a very powerful tool. So evaluating where you are at in terms of old crop and what your potential to store a new crop is an important component right now for producers.
Okay, well then let's kind of look at the opposite side, Dr. Smith. What are other non-speculative marketing alternatives for row crops?
Well, right now it's pretty limited. You know, you can have your traditional cash sales at elevators. You can look at doing things with basis right now where there's some potential opportunities, although those have been greatly diminished in the past couple of weeks here. Those are tools that can end up allowing you to end up looking at pricing some crop. Obviously, you can look at cash forward contracts as we look out to the harvest interval and see what's offered out there. Unfortunately, those do track with the futures market, so there's probably not very many attractive alternatives right now. Hopefully, producers have some of their 2020 production already priced and took advantage of some of the opportunities earlier in the winter that allowed producers to price corn up around that $4 mark on the futures side of things. One that I think everybody can do right now, look at what the on-farm storage capacity is for your individual farm, see how much you will have to price at harvest, or how much you can end up storing and extending that marketing interval.
Awesome. Well, thank you, Dr. Smith, for joining us today, and thank you to the viewers for joining us on Crops, Cattle, and Charley. We hope to see you. We hope that you will join us again on the next one. Thank you.